Scott, I'll start with you. Can this continue?
David, I tell you, the market, we had a 30-30 year-end target for 2019. Obviously, we're going to blow that away unless something crazy happens. And we certainly expect some positive returns next year. But, total return may be something in the mid-single-digit kind of range. So we're not expecting certainly a repeat of this 30% total return we've seen so far in 2019.
Yeah, it has been quite a significant rally off the lows, if you want to call it that. Scott, what do you see sort of becoming more of the themes as we move into next year?
Well, I tell you, for us, we did expect minor trade positives. Now, I think if you see a rollback on September, 50% or whatever, that's a little bit better than what the market's been expecting. That's better than what we've been expecting, and it's happened sooner than what we've expected. But I think the theme really for next year, it's going to revolve around, are we indeed seeing some stability and potential increase in global economic activity, or at least something better there? And are we going to see some CapEx spending? Now, this trade deal is not going to cause CapEx spending to increase overnight. I mean, this is going to take a little bit of time, maybe sometime in the latter half, the latter quarter of 2020, you start to see some numbers that reflect it. But certainly the market's going to be, if it appears that is what's going to happen, the market's going to reflect that well in advance. So I think for me and for our group, as we look out, it's are we indeed going to see some trade positives, and are we going to see some stabilization and a little bit better news abroad?
David, I guess the big question is, now that we've had this rally, the market seems to be kind of emptying the tank on the way to the year end, getting this 30% total return. What is priced in terms of a global recovery next year, both in U.S. markets and non-U.S. markets, and is there any opportunity left?
Well, I think there are opportunities, particularly outside the United States. I mean, the U.S. economy is fascinating because it's almost in exactly the right place, but it's kind of like in your house if you crank up the heat and then you throw open all the windows. So you cranked up the heat with the tax cut. You threw open all the windows because of all the trade tensions. You actually end up with about the right temperature. Obviously the heating bill is yet to come. But the U.S. is really in a very nice place. But if you look at relative valuations, the rest of the world is a lot cheaper. And I think what's going to happen over the next year is trade tensions will gradually diminish and the global manufacturing sector will pick up. And that should help the rest of the world much more than the United States. So I think 2020 will be a year in which international equities ought to do better than U.S. equities.
You have written about Brexit extensively here. How do you think that the election in the UK and a hard Brexit will affect opportunities there?
Well, I don't think that we will have a hard Brexit because I think the whole problem was that Theresa May and then Boris Johnson were relying on the Northern Ireland Unionists who said there could be no border in the Irish Sea. Now that he's got this huge majority, he can make whatever compromises he wants. Now he's actually very pragmatic from a ideological perspective on this issue. He's not really a hard Brexiteer at all. So I believe that he will say Brexit, get Brexit done, but then from an economic perspective, the closer the coordination of regulations, the lower the tariffs, the more everybody wins. And I think Boris Johnson will look forward a few years into his premiership. I think he really wants to make sure that the British economy is in good shape. That means actually coming to a deal with the Europeans. And I think we'll be much closer to the current arrangements when we finish up than people think. So I don't think it's going to be a hard Brexit at all. I think in the end, we'll get a soft Brexit.
Scott, looking ahead to perhaps mid-single-digit returns next year, it's kind of where the consensus is roughly coalescing and also where the math gets you to. I mean, historically, you had a big up 20% plus year. The averages for the next year are single-digit positive returns. But in any individual calendar year, it almost never happens. So I wonder where you think the direction of surprise might be, either on interest rates or something that we're not yet computing that's kind of generating that consensus for next year.
Well, the surprise could be, we see better economic activity globally, maybe even here in the United States as well. I mean, our official number right now set back in October is 1.8 GDP for next year. So you get a surprise there. You get a little bit better economic activity abroad. Another factor that I didn't mention earlier is, you've got a lot of retail investors that are meaningfully underinvested in this market and have been for a long time. And you have some professionals as well. So, the fuse is lit. There's a little bit of chasing going on. You get a little bit of positive news from some of these other areas that I just spoke about. And, the market could carry itself higher than a lot of people really think if a few things come together. So, those are a few things we're trying to watch. We don't sense a lot of chasing right now, but certainly when you're at this stage of an economic cycle, it's really common. The chasing starts, it plays out over 12 or 24 months, and that takes you into the top.
And David, I know you mentioned that you think international equities may be a better place in the new year in 2020, and you gave a little bit. Give me more sense as to perhaps what markets you're talking about. I would assume or not, perhaps that emerging markets are not a part of that. A little more specifics.
Well, no, I think emerging markets are part of it. In fact, I think emerging markets are more levered to the global trade cycle than anywhere else. And they're also relatively cheap. So I think emerging markets will do much better. I think also Europe will get a bit of a dividend out of a Brexit deal or Brexit clarity. I mean, remember, the biggest tax from Brexit isn't really Brexit or tariffs, it's uncertainty. So as uncertainty diminishes, that should help the European economy, and certainly European markets have been lagging. Obviously, the one thing we need to see in Europe, though, is some move away from these negative interest rates. The European Central Bank has been pursuing this disastrous policy. So I think that's critical for Europe, is to have more sensible European monetary policy. But if I had to make one bet around the world, it would be in emerging markets because of diminished trade tensions.